Well, there we go. The final trading day of the week is officially underway. Right now, we're looking at about a mixed open as traders and investors are still digesting the new numbers that came out just about an hour ago. 143,000 jobs were added to the U.S. economy, as well as unemployment falling to 4% from 4.1%. We'll be covering that throughout the show. Now, joining us now to break it all down and to discuss how to navigate these changes is Jonathan Dane, founder and chief investment officer at Definat Capital Group. Jonathan, welcome to the show.
Hey, good morning. How are you?
Great, thank you. So, we've been talking about it throughout the show. The January jobs report came out just about an hour ago. What are your biggest takeaways from the results?
We looked at the report and it said a lot of the things that we thought we already knew that were happening in the economy, and it solidified them. So one, the unemployment rate is going down. For us, the biggest thing has been this labor market. How strong is it? Is it resilient going forward? And so while there were some revisions to it, and yes, the numbers came in a little bit weaker than expected, overall, this is still a strong labor market. The unemployment rate going down, in fact, wage prices are going up. And so when you see all of these things happening, the unemployment numbers are the biggest thing to us. The participation rate went up, and that's really what's driving these things. And so we think it represents we are still in a strong economy. Obviously, the curve is moving in that same manner too. And so we look at it and think the economy is on a good path going forward, and that the Fed has a really tough decision ahead of it.
And going into today, we understand that you believe that there are key indicators to watch that could signal a significant pullback. Tell us more about this.
Yeah. For us, we're really watching the labor market. The first sign of weakness that we see there is going to be the time to start pumping the brakes. So we're watching that every day. The other thing that we're watching is the spread between the 2 and the 10-year on the Treasury curve. Right now, you still have this gap between the two where the short end of the curve is telling us, hey, we might be in for some more inflation. You need to watch, you need to take a step back. Meanwhile, the long end of the curve is telling us that the economy may be slowing down. There's a disconnect between the two. And so we're watching those very closely. And then on top of that, we continue to watch the Trump administration's policies because in and of themselves, they are very inflationary and biased. And so we're watching to see what happens as Trump continues to put his policy into play, as the deportations happen, as he reduces the size of the government. How does that impact the labor market?
And could the combination of a weakening labor market and inflationary pressures lead to stagflation? What factors do you think we would need to align for that to occur?
Right. It's a big concern of ours right now. I would say it's the biggest thing that we're focused on because you have a three-headed storm of pieces coming together. As we talked about the labor market, you have price pressure on the consumer from potential tariffs. So how is that going to impact the end consumer? And then you have the Fed and Trump trying to push the Fed to lower rates. And so if we look at all those things together, you have what's brewing, the potential for the labor market to slow, which would drive the economy slower. And yet we're in an environment now where because of the policies, because of lower rates, we have inflation skyrocketing. And that's a real concern of ours, and it's something we're going to be watching, not right now, but more towards the back half of this year.
And we touched on it a little bit earlier on, but the Treasury yield curve is showing concerns about inflation and slowing growth. How do you interpret these movements, and what does it tell us about the market outlook for the broader economy?
Right. The yield curve is everything that we need to watch right now. And if you look at today's moves, everything is moving up together. So what it tells us is that people are looking at today's numbers and there's no real read through them because you can't tell from today's numbers if there's anything going on. But if you looked at it from the end of January to the beginning of February, what we saw is the short end continuing to move up and the long end continuing to come down. And that to us is saying there is that disconnect. There is this gap where longer term we think the economy is slowing, shorter term inflation is here. And that's really what we're focused on is how much does that gap continue to change?
From your vantage point, how should investors adjust their portfolios in light of these potential inflationary pressures and a slowing economy? What sectors or asset classes should they be focusing on?
So if we start with where to position your equity portfolio, as we think the economy is strong, we want our clients to be in equities. Energy remains a great trade for us. You have tailwinds from the AI trade. A lot of the news coming out about DeepSeek is really becoming they did this for a lot of money. There's still a huge demand for energy. There's still a huge demand for AI data centers and chips. And we think energy is the vertically integrated way to play that from top to bottom. Inside investor portfolios, though, we're really focused on if you have a diversified portfolio and you want to hedge against risk in the economy, look at your fixed income and potentially adjust that. Move into shorter duration vehicles, put some tips in there, put the pieces in place that one, take advantage of this lower inflationary environment right now, but two, as inflation ticks up, you're not going to get hurt, you actually benefit from it.
Jonathan, we have about 60 seconds left here, but given the Trump administration's policies, you believe that large cap U.S. equities will continue to perform well. How do you think that these policies specifically benefit mega cap stocks, and which industries are best positioned for maximum growth?
If you're investing in the equity market right now, mega caps are where to be. We think that the policies, the way they're designed, the way they're being implemented, the biggest companies will continue to win. If you look at the new personnel being put into the administration, into the government, we think the big companies win. The Mag 7, there's a lot of gas coming out of them now. That is a short-term speed bump. We think they still continue to perform. We're not seeing any indications they don't. I mentioned before energy. We really like energy right now. We think it just has so many hedges from inflation to the tailwinds in the economy. So we're pushing clients to be in all of those places right now.
Thanks again for all of that key insight, Jonathan Dane, founder and chief investment officer at Definat Capital Group.
Thank you.